What's going on? Welcome to my channel. I'm the covered call guy, and my goal here, my journey, is to create $120,000 in annual passive income using covered call ETFs. Right now, my projected annual dividend slash options income is about $76,000 a year, 6.3K a month, 1.4K a week, and about $200 per day. Legal disclaimer before we start this video: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just some random idiot you found on YouTube and I could be completely wrong. Now, with that out the way, let's talk about Chippy, right? Because going back on my past two videos, I think on the Monday, I think it was I talked about stacking, right? And one of the ETFs, I think I mentioned it was Chippy. If not, then I mentioned it that in my comment section. This is one of the weekly pairs that you guys are hammering in and buying up, and there's nothing wrong with that, right? I mean, some people don't like it because it's from YieldMax, and some people don't like it just because it pays a little too much. But it's been doing well, and I'm starting to see a lot more people talk about it in the comment section. I'm starting to get a little worried for you guys, and I gotta break it down and digest it and try to come up with at least this is how you should be playing around it, right? So I'm gonna call this the Semiconductor Triple play. We're gonna be looking at structurally hedging volatility, why Chippy deserves SOXX and DIVO to play around it. So I'm gonna break it down. Hopefully you guys get something out of it, and if you're already doing this, good for you. And then we have great mind things alike. All right, so red alert, right? I'm gonna give you the big warning here is that capital risk escalation. All right, we're looking at Q1 of 2026. Right, you're no longer operating within the bounds of traditional portfolio theory, right? This is not a late cycle or a rotation. It is a structural stress event, right? So these are masked by headline yields and distorted by derivative driven optics, right? Don't think just because you bought Chippy in the low or in the low 40s or 30s and now you're up 50%, right? It doesn't make you a genius. It should make you a little wary and scared, right? When it shoots up like that, especially when these covered call ETFs or these income ETFs, you have to be a little bit wary. All right, let's talk about the danger zone, right? Alpha versus beta, right? The proof that everyone sees, I'm going to mention it real quick, is investors look at the 1 year total gap return. I'm going to compare Chippy. It's up 72% versus a dividend growth like SCHD, right? Around 8%. To them, this looks like superior management, right? Now, let's break it down what alpha and beta is when I talk about this. Alpha is your skill, essentially, in regards to this, ETF, right? You think you're outsmarting the market. Beta is exposure, riding the market's risk. So are you actually outsmarting the market because you got a good pick, or just because you just happen to have bought Chippy because you wanted it weekly, you wanted tech, and it just happens that the market cycle is riding the market onto the AIs and the technology, right? The Qs. You have to look at the reality check here. And what I think it is that Chippy's 72% isn't skill, right? It's not your alpha. It is pure leverage to the semis. The beta, you're getting paid to ride a wild bull. If the bull crashes, your income crashes, right? That is risk, not genius. So diverge from it, right? Give yourself a round of applause. You got a good ETF. You picked well, but don't think it's gonna keep going. It could keep going up and up and up, which is hence why I have this triple play. But you are betting against the risk of a market cycle correcting, and then what happens, right? Remember, this is an income ETF. It operates a little bit differently, so don't have that growth mindset. Okay. All right, two shock forces I'm gonna talk about, right? These are not just market headwinds. These are regime level discontinuities that change the rules. The first one is geopolitical fracture, right? We talk about Liberation Day that happened of April 2025. Tariffs didn't just add costs, they abruptly repriced the entire global supply chain and capital flows for semis. That was one of the big push. Second, it leads because of this, it led to number two, the demand shock, right? Which led to the rise of DeepSeek. If anybody remember DeepSeek, right? As of January 2026, this AI efficiency breakthrough challenged the infinite demand thesis. It proved we might need less compute, not more. All right, let's talk about Chippy, right? When performance equals risk, right? Chippy has not simply rallied, it has detonated. For those who bought since the beginning, you guys have done exceptionally well. Congrats, congrats. This is not a hater video, okay? You guys have done exceptionally well. Give you a big round of applause, right? You're collecting that great NAV growth plus extremely high option premium, so good job. However, I think, right, with its rapid price appreciation has created the illusion of safety at precisely the moment when none exists. Everybody now is talking about it. Everybody now is hyping it up, right? That should create a little bit of fear, a little of skeptical, right? When everybody's talking about something and piling in, it's like, whoa, okay, let me step back and reevaluate, right? This is not capital compounding. It is capital acceleration under stress. Everybody now is trying to get into the room and get a piece of it. All right, so I think here is that a lot of people are misreading the signal, right? I want to say Chippy surge is not exactly 100% strength. It is just evidence of maximum exposure to the semiconductor volatility, right? It represents a systematic upside forfeiture in exchange for yield. The sharper Chippy rise, the more fragile it becomes. This is how yield trap forms. Not quietly, but loudly with applauses, right? Everybody is going out and saying, buy, buy, buy. We this is the best income stock. This is the best mag, I think it's a mag 10 stock. It has 10 holdings. I have to double check, but like it's pretty much essentially everybody is piling in and telling you that that is basically one of the best holdings that you can get, and that's why it keeps going up, right? There's a lot of excitement around it. There's a lot of kind of that trend, that meme hype, right? Oh, this is the best weekly payer, and that eventually can lead to kind of euphoria and kind of what is that? What is that? Like in like 2020, all the meme stock jumped up and then it crashes down. So you have to be aware of that. And when I say 10 holdings, it's basically their 10 holdings has like their 10 holdings that they make up like 70% of their entire holding. They have like 100 something holdings, but when I say 10, it's essentially 10 because their 10 holdings represent like 70% of the entire holding. So one of them can fall and it could pretty much destroy your payout and or something happens to the ETF. So just something to be aware about, okay? All right, so the false sense of security, I've mentioned this, right? You are mistaken distribution for durability and yield for defense, right? Chippy does not own businesses, it owns price behavior. It monetizes volatility by selling the very rallies required to repair capital after drawdowns. Now, three competing frameworks, only one survives the shock. And what is it? Systematic volatility Chippy, a rule-based derivatives engine. Upside is capped, downside is not, right? So failed catastrophically when volatility exceeds implied expectations. Recovery is sold to fund income. Performs best in narrow range-bound conditions, which we are not in right now. I don't believe we are in right now. It might be slightly choppy, going up, sometimes ticking down, ticking up, but at the moment, I don't think we are in the right conditions for Chippy. All right, so what should we do? We should pair this with a passive beta, right? I think Chippy goes hand in hand with the ticker symbol SOXX. I'm gonna say SOXX. I think that's it is. So when I say SOXX, it's ticker symbol SOXX. All right, so if you have Chippy, you should own this other half. Full exposure to drawdowns, but also full participation in recoveries. Painful during crashes, essential for capital repair, non-negotiable for long-term survival, and a power law industry like semiconductors, right? So it's very painful for growth during the drawdowns. However, if you have Chippy, you have that buffer, right? You have that payout. It is fine. It is 100% a-okay. This is what SOXX is determined to do. You put those payouts and you buy the dip with SOXX, right? And then now the third one, I was gonna put SCHD, but I'm gonna replace it with DIVO. Why? I did choose SCHD because it didn't have any text, so there's no correlation. But I think DIVO is the better choice here. Why do I think it's a better choice? Well, it has better selective equity ownership, balance sheet screening, and discretionary options rating. And also DIVO pays monthly too, so that's one of the biggest reasons why I chose it over SCHD. Right, it preserves upside participation, allows capital to remain functional during shock events. Right, DIVO has been a major with a decent amount of historical data, so it's proven. Right, so I think it's better choice than SCHD because I originally chose SCHD because it didn't have any tech in it. But I was like, you know what? Just because it's uncorrelated doesn't mean you shouldn't choose something with without tech or with tech. And it pays quarterly. DIVO is just, I think DIVO is just a little bit more. It can place both defensive and offensive. So I like the way DIVO operates. Right? Why passive value? SCHD died. I guess I got a little too far ahead of myself, right? So no tech exposure, right? Avoiding tech is not safe. It's annoying the engine of global growth and no adaptation, right? It's 100% pure passive value, offers no tactical volatility management. It cannot adapt to regime shifts, right? So replacing SHD with active tactical management, DIVO is a necessity. Right, this is the moment where capital is decided, right? Your yield cannot save you, only your structure will. Right, so scenario 1 is Liberation Day, as I mentioned earlier, April 2025. A severe liquidity shock from sweeping tariffs caused the Nasdaq to enter a bear market in days. Right, the failure of Chippy launching into this storm. Chippy suffered from the short gamma. Right, the massive decline in its synthetic long position overwhelmed any option premiums collected. Scenario 2 is the DeepSeek shock. What happened? Well, in January 2026, right now, the DeepSeek AI model proved that high-level AI reasoning could be achieved cheaply. Right, this has basically shattered the infinite demand narratives or GPU. Even if the GPU, RAMs, and all the other stuff right now is exploding in price, we see the market result. Right, Nvidia dropped 17% in a single session. Chippy took a direct NAV hit. The yield percentage looked higher due to IV, but your actual capital eroded instantly. Right, so don't be fooled by that. Right, so the Chippy, the systematic trap, right? I talk about a little bit of this when we get into a deeper dive here. Is that systematic negative convexity, right? If the market rips higher, like V-shaped recovery, Chippy is mathematically forced to cap its gains, right? If it participates fully in a downside crash in a volatile sector, this ensures NAV erosion. Okay, we are not in a perfect condition right now for Chippy, but this is why I encourage the triple play method here. Right, and then we use SOXX as the engine. Pure positive convexity. It captures 100% of any rally. This uncapped exposure is non-negotiable for wealth creation. Right, capital repair. SOXX uses rally to repair drawdowns damage. Right, Chippy sell these rallies. Right, so you can play both the growth and the income. You're playing both high yield plus growth here. Right, and then DIVO is the bridge. Right, this is managed convexity. I know I keep saying it, so I'm gonna say in this sense, is convexity simplified means you participate in most of the upside boom, but you cut off the deep downside crash. Right, so unlike passive indexes, DIVO actively selects fortress balance sheets and write calls tactically only when it makes sense, not blindly. Right, they are from Amplified, and most of Amplified's strategy for options is tactical, call option writing. All right, so this is just an analysis here, right? Quant analysis of 2022 stress test. All right, we look at the massive spread in a drawdown performance. SOXX has dropped 35% versus DIVO at, I believe, 1.5%. So this difference here, you see negative 35 versus 1.5. This is your capital buffer, right? It prevents you from panic selling at the bottom. So You know, the stress test has really proven DIVO has done extraordinary well. This is why I add this triple play. Don't just have SOXX. SOXX is great. You should have, if you're gonna have just a pair, Chippy and SOXX, that's okay, that's fine. But if you want that extra protection, that hedge, right, DIVO, there's no doubt about it. All right, the yield trap versus total return, right? Oh crap, it didn't load. It did not load, but essentially it's saying that Chippy is mostly handing you back your own principal, while DIVO is the income that doesn't cannibalize growth here. I don't know why I didn't load it. Okay, but that was basically it. All right, limitations of active defense, however, right? There's the good, the bad. I talk about it all. All right, so of course there's the manager discretion risk. Poor timing can lead to underperformance, and of course the melt up drag and a speculative mania. DIVO will lag hyper growth names. All right, DIVO is not for growth. It is an income tool first, not a growth engine. It cannot replicate SOXX speed. Okay, SOXX is the pure growth. DIVO kind of plays the both side, income and a little bit of growth at the same time. Not that super hyper bullish market that just shoots up. DIVO will lag, but that's where SOXX pick up the slack. Right, failure modes of the strategy, right? We talk about the uncorrelated crash. If a recession hits both quality and growth simultaneously, diversification collapses, it's useless, of course, right? You're hitting both. All right, the Chippy death spiral. If Chippy drops more than 50% followed by low volatility, it may never recover. Your satellite allocations become a realized loss, so just understand that, okay? All right, ecosystem correlation here. SOXX, we call it the maker, right? Owns Nvidia, Broadcom, Micron, High Beta, and Cynical. DIVO is the customer, right? Owns Microsoft, Apple, Meta, massive cash piles, and durable models. By holding the customers via DIVO, you maintain exposure to the AID via lower beta balance sheets. Okay, you want to play. I'm trying to build your portfolio around, not portfolio, but I'm trying to build your core satellites and satellites around each other. That way you're playing every single spectrum of your your whatever you're trying to hit, whatever sector you're trying to hit. All right, capital flow diagram here is phase 1, expansion, right? SOXX runs unhedged, reinvest into Chippy, distribution into SOXX. Phase 2 is correction. SOXX drawdown, DIVO holds value, use Chippy cash flow to buy SOXX aggressively. Right, phase 3 is the recovery. SOXX repairs damage via convexity. DIVO participates. New capital deployed near bottom. Right, so now the recovery, SOXX is booming. You see, now you can sell off some SOXX to kind of delve into Chippy or DIVO. You're playing all sides of the game here. All right, my bottom line: anyone buying Chippy without stacking stock is harvesting income while silently selling their recovery. Right, so a systematic yield of Chippy. Of course, you're going to play with active defense of DIVO, playing it with active direct ownership of SOXX. This is how I think you should be playing it. If I know a lot of you are mentioning Chippy in the comment section, and some of you are like having 10, 20, 30% of your entire portfolio. You need to protect your Chippy income position. So please think about it. Run your own numbers, run your own models, run your own diagrams. See how this will play out for you, okay? And do not want you guys to get burned. All right, so knowledge is profit. Help me beat the algorithm like I'm hoping you beat the whatever high income, high allocation, high yield game out there. All right, don't miss the next update. Smash that like, subscribe, get notified. I hope this was educational, informative, creative, funny, that you got something out of it. All right, hopefully good. If it's bad, let me know what I should improve on. I always appreciate all comments. I truly mean that. So if you leave a comment, criticizing me, I take it to heart, but I don't take it in a way that I'm gonna get mad, right? I take it to heart, be like, all right, maybe I missed something or I said something incorrect, and I shouldn't have said that. So I appreciate everybody who leaves a comment, everybody who kind of subscribe, of course, and leave a like, share my videos. You guys are definitely the best. Thank you for helping the channel grow. Thank you for helping me grow as an investor and as a YouTuber. Thanks for watching. Catch you guys up next. Stay tuned.